Here's a recent trade I just finished. A huge 10% gain and massive profit, helping my portfolio so much. How did I know this chart was about to go up? Because of this candlestick pattern right here. And in this video, I'm going to share my favorite candlestick patterns just like this one that I use on a daily basis. That way you can read and understand chart patterns, predict chart direction, become a more successful trader, and make plays just like this one. Let's get straight to it, shall we? Before we dive in, if you're trading with prop firms, make sure to check out coupontera.com for exclusive prop firm deals and discounts. And also visit Prop Firm Ask for in-depth reviews of different firms, so you know exactly which one fits your trading style. The engulfing candle. One of my favorite and most used candlestick patterns is the engulfing candle. I've used it in many of my previous videos. It's such a strong candlestick because it can give you the exact point of when a reversal is about to happen. So what is an engulfing candlestick? Well, it basically explains itself in the name. It's a candlestick in the opposite color of the previous candle, and it simply engulfs it. A bullish engulfing candle opens at, or lower than, the previous candle's close, and closes above the previous candle's open. So basically, it's bigger than the previous candle on both sides, making it look as if it's swallowing it. Example, bullish. Here, we found a strong support where price bounced off multiple times. That tells us the market really respects this level. Price comes back down to support. We can expect it to bounce up. But before entering, we need more confirmation rather than just assuming support will hold. That's when we see a bullish engulfing candle. It completely engulfs the previous red candle, right at the support. This is an extremely bullish sign. So we enter the trade and look what happens. Now, it's important to note, just because there's a bullish or bearish engulfing candle, doesn't mean the price will reverse every single time. You shouldn't be trading purely off candlestick patterns. Think of them as hints on which way the market might go, not pure decision makers. Always use them with other tools like support and resistance, indicators, and different strategies. Example, bearish. Here's a bearish example. We have a strong resistance where price respected it multiple times before. Price comes back up, slows down, and we get a bearish engulfing candle. It completely engulfs the previous green candle. This tells us resistance is holding. A great place to go short. And look what happens. The momentum candle. Next we have the momentum candle. This one's easier to spot than the engulfing candle, purely because of its size. A momentum candle is simply 2 to 3 times bigger than the previous candles before it. This candle is insanely powerful, because most of the time, after it forms, price will continue in that direction. That makes this point a great time to enter. The best way to use this candlestick pattern is in choppy markets where price is moving sideways. If you ever see a sideways market, and then a huge momentum candle appears, 2 or 3 times bigger than the candles before it, you can be pretty confident price will continue in that direction. Why is that? Think of it like this. In sideways markets, a lot of shorters are stuck in their trades. They set stop losses above support or below resistance. When price breaks out suddenly, all those stop losses get hit, adding fuel to the fire and driving price further. Also, when price breaks a choppy market like this, it usually starts a trend in that direction. It works the same way for shorts. If you see a big red candle 2 or 3 times larger than the others, breaking downwards, that's a strong sign price will keep falling. The multiple candlestick pattern. Next, we have the multiple candlestick pattern. This is one of my favorites, and it's super simple. It happens when you see 3 or more candles with wicks pointing in the same direction. The more candles, the stronger the signal. Example, bullish. Here's an example. We've got a key support where price bounced multiple times. Then, multiple candles appear with downward wicks at that support. This tells us sellers are trying to break support, but buyers are fighting back and winning. That confirms this support is strong, and price has a good chance of bouncing upwards. Example, bearish. Here's the opposite. Price moves up to resistance. We see multiple candles with upward wicks. That shows buyers are struggling to push higher. A great short entry. And look what happens, price reverses down. The doji candle. Next, let's talk about the doji candle. The doji is a candlestick with a very thin body and wicks on both sides. It represents uncertainty in the market. And uncertainty often leads to a reversal. Example. Here, price is moving down hard. Then, a green doji candle appears. That tells us sellers are losing confidence. And buyers are starting to step in. My approach? After I see a doji, I wait for 2 or more candles in the same direction as confirmation. If it's bullish doji, I wait for 2 green candles before entering long. Boom! Price takes off upwards. There are also variations of the doji. The long-legged doji with larger wicks. The dragonfly doji with a big bottom wick. The gravestone doji with a big top wick. They all tell the same story. A reversal could be coming. The hammer and shooting star. The next candlestick is the hammer. It has a decent body and a long wick at the bottom. This shows sellers pushed price down, but buyers absorbed the pressure and lifted price back up. That's usually a bullish signal. The shooting star is similar, but flipped. It has a long wick at the top, often. The tweezer. Next up, the tweezer pattern. This happens when you see a red candle followed by a green candle, both with similar wicks. Example, bullish. Price comes down to support. We see a red candle with a bottom wick, followed by a green candle with a bottom wick. That's telling us buyers are stepping in. A great place to go long. And look what happens, price rises. Example, bearish. The bearish version is the opposite. A green candle followed by a red candle, both with top wicks. That signals resistance and price falls from there. The Marubozu. The final candlestick is the Marubozu. The bullish Marubozu is a big green candle with no wicks. Just a solid rectangle. This shows buyers have complete control. And usually, price will continue trending upwards. The bearish Marubozu is the same idea but red. It shows sellers are in control, and price will likely keep dropping. Bonus tip. Now here's a bonus tip for making it to the end. You don't have to memorize all of these patterns. Why? Because TradingView can do it for you. Just go to indicators, type in the candlestick pattern you want, like bullish engulfing, and add it. TradingView will mark the patterns right on your chart. You can even add multiple candlestick indicators at once, making it super easy to spot setups. Before we wrap up, if you're trading with prop firms and want discounts on challenges or funded accounts, visit couponterra.com for the best deals. And check out Prop Firm Ask for trusted reviews of different firms. I hope you got value from this video and learned something new. If you did, please take 5 seconds to hit that like button. One last thing. The biggest problem with candlestick patterns is false breakouts. Sometimes a pattern appears, but price does the opposite. If you want to learn how I avoid those situations, watch this video here, where I share my secret strategy for avoiding false breakouts. Thanks for watching, and I'll see you next time.